Hello friends, welcome to the Good, Bad and Ugly weekly review for the week ending 17th of January, a week uh, which was not so bad, I would think, given that the previous week was really horrible and some very important levels were getting tested. So there could have been a waterfall kind of a week where we just broke the level and went down few percentage points, but that has not happened. We got some bounce and I think the market is now keenly awaiting the Trump speak post Monday and the expectation rally, if any, from the budget, and then the budget itself on 1st of February. So the next 2 weeks is going to be very uh, speech driven, what people say and how markets react. For the Trump part, the tariffs on Indian exports is the key focus area. More than that, I think the nature of the policy going forward, how it impacts US dollar versus currencies, I think that is going to have a lasting impact on where we are. Most currencies have gone 5 to 10% lower in anticipation. We've gone only 2.5% lower. So there is some sort of a finality of that decision making that needs to come there. So we'll talk about that a bit later. But we also are doing a momentum misfits video on every Sunday. This is about stocks that in our momentum scores are at the lower end of the spectrum, whether they are large cap, mid caps, or small caps, and we name few stocks so that if you are having those stocks, you can possibly review your decisions. From our research desk this week, we came out with all these research pieces, a lot of investor behavior orientation, market diversification orientation, uh, comparison Indian to US market, gold stories, short versus long term goals, emerging market versus gold. Are you keeping expectations in check? India is poised for a leap. So many mixed bag of all kinds of facets of the market, and the investor behavior is the focus in all those stories. And this you can read on our Weekend Investing blog at our website. There's a newsletter that comes every day. Some of these stories are there. You can read it there, and you can also see things on the English and Hindi YouTube channel. So we now have two YouTube channels. The Daily Bite is now being sent on both YouTube channels. There's a lot of ask from Hindi channels viewers that we want Daily Bite here also. So I've added the Daily Bite to the Hindi channel also. So there is enough content for absorbing, and there is of course a good back and forth discussion in comments or on the app, or otherwise work with other market participants also. So it's a good sort of a community building thing that happens. Do read the disclaimer. This is very important, and do subscribe to the channel. This is most important. Nifty daily chart with 50 and 200 DMA. So we lost about 1% this week. We were here last week. This was the breakdown point. We did break down and we are still there. So it really did not go vertical like it could have. So far, we are still consolidating here, and that's a good consolidation. If we can pass this next 2 weeks within this range here, I think that is possibly a good outcome in my view. I have no hopes of market going vertical, but gradual consolidation here, then maybe some climb back up gradually. That probably is the way to be. One more thing that you will notice is that the 50-day moving average has now breached the 200-day moving average. This is called the death cross. The death cross has a higher probability of the markets going lower. Just wanted to mention that. On the weekly chart, we are just below the support. We've made a doji candle, which is an uh, indecisive candle, uh, and that in some ways does mean that there is a possibility that we may bounce back, um, but there's always a possibility of this support just giving up in a big way if something negative comes around. So now I think the fall will be triggered by some negative news is what I think. I think the fall has been reasonable. We've come back to where we were in May, June. So 7 months of, you can say, time correction has happened. And fresh triggers are now awaited. The results have also, the first few results, Axis Bank, Infosys, did not really come out blazing, but I think the market has absorbed that very nicely. S&P 500 is very, very strong, 2.9% this week. Possibly the market is welcoming the new president in. Uh, they've not lost anything from the top. So US market is doing really, really well. No doubt about that. Gold is doing quite well. Gold in INR terms has closed at a all-time high weekly close once again. We are nearing the 80,000 per 10 gram mark. There is a lot of statistics that I can show you where gold has really played a very big role in a lot of portfolios. So if you don't have any in your portfolio, do add. If you already have, add more. Uh, this is very, very important in my view, at least. Dollar index, which has been rising like a phoenix from 100 to 110 now, is witnessing a slightly dull week in this last 1 week. Uh, but again, I mean, it has broken out of these two tops. It will take a while for this to make a downward correction kind of a move. Even if it corrects down, the intermediate trend seems to be towards the longer side. So it needs to make some consolidation, something, or break this low here before we can really say that dollar index is coming down. Once dollar index starts its downward journey like it did here, you will see tremendous FII inflow. You will see, other NRI, etc. remittances also increase because everybody wants to move towards a stronger currency. Right now, what is happening? The narrative is that USD INR will go to 1995 soon. That is the general sort of, somehow this narrative is going around. Now we are at 86. Anybody who wants to bring in money, let's say you are an NRI and you want to buy real estate in India, you're saying, why should I bring it right now? Let me wait for 1995. I'll make 7% more. Or if somebody is wanting to take their money out of India, like the FIs who are invested, they are saying, let's get out right now at 86. At 1995, we can reconsider coming back in. So this narrative is actually causing poor decision making, because I don't think we are going to 1995 tomorrow, and that is causing a lot of decisions to not being made. So it's always best whenever markets are going into correction mode, or any target has to be met. It should be done quickly and swiftly so that decisions can be done. Um, I'm hoping that the RBI is not stopping the dollar, because in another study, that video that we did, um, Indian USD INR has just fallen 2.5% since September, whereas all other emerging markets, many countries have gone 6%, 7%, even 10%. So on a comparative basis, we need it to be lower, but we are still holding there, thanks to RBI, I suppose. The benchmark indices overview. So let's look at the benchmark indices overview. Last 1 week, Nifty Next 50 has sprung back 1.24%. Remember, this was the biggest loser also. If we see over the last 3 months, Nifty Next 50 lost 12%, whereas Nifty lost 6%, and mid and small caps were in the middle. But this week, Nifty Next 50 has recovered a bit. Others were flat. Nifty was down 0.97, Nifty small cap 0.79. Nothing much was lost this week, at least. In the last 1 month, of course, everything has been red. Last 3 months, also red. In last 6 months, again, you can see bloodletting. But last 1 year is still green. So that's what I continue to say, that don't look at very short-term performances. You basically are also wanting to see what is the context in which the correction is happening. In the last 1 year, despite this correction, Nifty Next 50 is up 20%, which is even higher than what a 1 year long-term average is for Nifty Next 50. Nifty 50 at 7.56% is, yes, a little below average. small caps are where they should be. So on a 1 year basis, the market is where long-term averages are. On a 3 year basis, we are still possibly ahead on the mid and small cap space, lagging on the Nifty 50 space. So Nifty 50 is at 8% for the last 3 years, is lagging the long-term average. If we take a 5 year view, then we are all right on the Nifty 50. On mid and small caps, we are a bit ahead. I would imagine 15 to 17% max kind of a long-term average for small and mid caps, and we are riding far ahead of that. Even Nifty Next 50 is riding far ahead. So the context of the current fall has to be borne in mind that in the last 12 months also, we are not yet on the indices in the red. In the sectors overview, this week we lost significant on IT sector, real estate, media, FMCG, services, consumption, pharma. These were MNC private banks, more than 1% kind of falls. And you had some pullback in PSU banks, central PSCs, metals, public sector enterprise, commodities, energy, infrastructure, oil and gas, and so on and so forth. Remember, again, here also over the last 1 year, only media, FMCG, and I'll also say energy and private banks, these spaces have not done well. Whereas pharma, auto, central PSCs, consumption stocks, MNCs, IT, infra, these have sort of done, what one would fairly, uh, uh, have from these sectors. Over a 3 to 5 year period, everything is more or less green. Oil and gas has not performed. I would say private banking has performed very poorly over 5 years. So again, uh, the sector allocation in your portfolios, if they are discretionary and you are heavily invested in certain sectors which are not performing, your portfolio will not perform. FMCG has done 12.2%, whereas there are many sectors which has performed above 20% over 5 year period. Why should our portfolio not be in those sectors? So always, at least from my point of view, is that you should remain sector agnostic, allow the rotation of the momentum strategies to get you into the best sectors possible and get you out of the laggards. Maybe they will do very well in another season, and once they do, we will get back into those stocks. So that's on the sector story. In terms of the weekly, monthly, 3 month, 6 month, 1 year momentum score that we calculate, we are having pharma, consumption stocks, autos, and infra at the top. IT has suddenly taken a beating on the very short term, but pharma and consumption stocks are still ruling. FMCG, unfortunately, is right towards the last quadrant of this table. FMCG usually in times like this should be at the top, where other high beta stocks, high beta sectors are coming off and money is going towards FMCG. But FMCG is so highly priced that even FMCG is not able to sustain it this time. So pharma and consumption stocks are probably where most of the money is rotating into. If we look at the trends, there has been an improvement in the number of stocks on the CNX 500, which are above the 200 DMA. It's gone up from 26% to 38% and 11% to 20% on the 50 DMA. That's a good sign in terms of a slight recovery coming through. In terms of the indices, we have, uh, if we just look at, let's say, 200 DMA, you have 42% small cap stocks are still above 200 DMA, 38% on mid caps, small caps, Nifty also 34%, and Nifty next 50 is where most of the crunch is. Very few stocks are above 200 DMA. And if we check 50 DMA, Nifty next 50 is only 6%, and Nifty 50 is only 10%. So most of the pressure is on large caps, and that is also evident by the fact that FIIs have been selling relentlessly. In the Nifty sectors view, let's say 200 DMA view, we have IT stocks. Most of the IT stocks are still above 200 DMA. Most 70% of pharma stocks are above 200 DMA. And then you have many sectors which are in 40 and 30. But you can see that energy is nowhere there. PSU banks nowhere there. Public sector enterprise 5%. Infra, autos. All these sectors are lagging or reeling behind. If we see very short term moves, then you have IT and pharma and some real estate and financial services in the lead here, and you in the banking space you again have very few. So it is very clear that the longer averages and the shorter averages, you have IT, pharma, which are leading. So if you are, let's say, a discretionary trader or an investor, you should look for setups within those sectors. Where is the strength in the market? So 500 stocks on this CNX 500, we are seeing 43% have crossed the 50 DMA, has crossed the 200 DMA at 43%. Death cross is 57%. Uh, Absolute strength, which we say is the when price is above 50 DMA and 50 DMA is above 200 DMA. Only 4% of stocks, 21 stocks out of 500 are really doing well in terms of absolute strength. And absolute weakness, where price is less than 25 DMA, 50 DMA, 200 DMA, is 180. So 37% stocks are in absolute weakness. So all you want to do is hopefully get out of either death cross stocks, or if not, absolute weakness stocks, and your portfolio should be all right. If we see this chartically, you can see that again on a sector basis. um, let's say golden cross. Health services are doing the best right now. So health services, health technology, some technology services, electronic technology, commercial services, these subsectors are doing very well. And absolute strength, if we see, we are looking at communications, non-energy materials, consumer durables, producer manufacturing. This is a different data set that we get prices from, and hence the labeling is also different. Uh, FII DII stats, all red, nothing to really talk about here. 4,900 crores, 8,000 crores, 4,500 crores, they are on a selling spree like nobody's business. Uh, let's see where it ends. Fortunately, DIIs have the muscle to right now combat this. So 8,000 crores, 7,900 crores, these are large numbers. Almost $1 billion on a daily basis is getting pushed through by DIIs also. And that is causing whatever little stability is there in the market this week. Cumulatively, of course, FIIs have taken out 69,000 crores and DIIs have put in 79,000 crores in the last 1 month. So this is where the market is overall. I hope you got a good review of the market. Do let us know if what you liked about this content, which of these metrics really makes sense for you and which doesn't make sense for you. We are constantly evolving in terms of what metrics to show to you, and do let us know in the comments your feedback, and do subscribe to the channel. Thanks. Bye.